Imagine receiving $1,000 of cash flowing straight into your account every single month, not from your day job, but from your portfolio, all without lifting a finger. That's the power of dividend investing. Dividend stocks pay you a steady stream of income, and once you have done the upfront work of researching and buying the right investments, the income keeps coming in automatically. It is one of the purest forms of passive income out there. In this video, I will show you exactly how to create a dividend portfolio that can pay you more than 5 figures a year. We will cover what dividend stocks are, how much you need to invest, which companies or ETFs to focus on, and the biggest mistakes you should avoid. Okay, first up, what is a dividend stock? To put it simply, a dividend stock is a company that shares part of its profits with you through regular cash payments, also known as dividends. So you can think of dividends as a thank you reward for being a shareholder. The great thing about dividends is that rather than having to wait solely for the share price to rise, dividend investors get to receive real cash in their pockets. Dividends aren't just nice to have, they are powerful. Since 1940, dividends have accounted for about 34% of the S&P 500's total return, meaning roughly 1/3 of investor gains came not just from capital appreciation, but from dividend income as well. Globally, the figure is even higher, with dividends contributing over 70% return since 1970. But beyond return contributions, dividends also bring stability. While the stock market tends to be volatile, soaring one year and crashing the next year, dividends per share have historically been more steady per PP. Even during recessions or bear markets, companies that commit to regular payments tend to keep rewarding their shareholders. This means that during periods of market stress, dividends have always acted as a buffer, providing consistent income even as stock prices swing wildly. For example, in the 2000s, during the so-called lost decade, while the S&P 500 posted a negative total return, dividends still provided a 1.8% annualized return throughout that period. Even for investors in Singapore, dividend stability isn't just a theory, it is a real thing. DBS, for example, has a long track record of rewarding shareholders with consistent dividends, while steadily raising its payouts over the years. Even during the COVID-19 crisis in 2020, when the MAS, the Monetary Authority of Singapore, asked local banks to cap dividends to preserve capital, DBS still continued paying out dividends. And once those restrictions were lifted, the banks quickly raised dividends again. This provides investors with something invaluable, which is reliability. While share prices may rise and fall, dividends offer steady cash flow, peace of mind, and a foundation for long-term wealth building. Quick pause. If you are into dividend investing, the moomoo app has some really handy tools that make dividend research much faster and simpler. For instance, instead of having to manually dig through reports, you can easily check the stock's dividend yield, payment frequency, and even its track record of dividend stability. Besides that, moomoo has a dividend calendar to help you track upcoming payments and a dividend ranking feature that lets you quickly find high dividend or dividend growing stocks in both the US and Singapore markets. And if you prefer ETFs, no problem. moomoo also curates lists of high dividend ETFs for your reference. Besides that, you can also ask moomoo AI just about any investing question, from understanding risks and opportunities to summarizing long financial reports, and even things like what are the top 5 Singapore dividend stocks to look out for? New users who sign up to moomoo SG will get to earn up to $1,120 worth of welcome rewards when you fulfill the terms and conditions. You will also enjoy zero commission trading for US, Hong Kong, and Singapore stocks. On top of that, you will also get zero commission for US options trades every month for up to 100 contracts. For full details, check out the promotion page linked in the description below. Now, angkat bolas aside, how much money will you really need to invest to receive $1,000 in dividends every month? If you put your money into a stock that yields 5%, you would roughly need $240,000 invested to generate that income stream. Or in other words, with $240K, you'll be getting $12,000 every single year. Sounds amazing, right? But let's be honest, most people won't have $240K lying around, unless you're one of those rich dudes who lock up over $30 billion in the bank. Then this one easy peasy. For the rest of us, that's where the dividend snowball method comes in. Instead of needing all the capital up front, the snowball works by starting small and letting your portfolio grow steadily through the magic of compounding. This approach, by the way, is one of Warren Buffett's favorite strategies. Here's how it works. Say you begin with a modest $10,000. You don't have $240K, you should at least got $10K kwa. Then every year you contribute $6K, which is just $500 a month. And you reinvest whatever dividends you have received. Stick to this plan and in 23 years, your portfolio will snowball into roughly $250K. What lah? But let's not stop there. Now assume the companies you invest in grow their dividends by 5% a year, which is very realistic since strong firms like DBS regularly raise their payouts. And let's say the share price grows at 5% annually. Fast forward 31 years and your portfolio will now grow to almost $1.2 million. At that point, your dividends alone could be paying you over $60,000 a year or about 5k every month, which is potentially more than your day job. And the best part, you don't even need to touch the $1.2 million principal. You can now live comfortably off the dividend stream for the rest of your life and one day pass the portfolio on to your loved ones. This isn't just passive income, it's the foundation of generational wealth, where the snowball you built keeps rolling even long after you are gone. Okay, great. So what can I invest in? For most Singaporean investors, the first stop is usually our local banks and REITs, and it's not hard to see why. The big three banks, DBS, OCBC and UOB, have a long history of paying solid dividends, often in the 4 to 6% range. Meanwhile, Singapore REITs are famous for the attractive yields of 5 to 7%, making them very popular with income-focused investors. But here's the catch. If your dividend portfolio only holds banks and REITs, you are really exposed to just two sectors, financials and real estate. And the problem with that is that both of these sectors are especially sensitive to interest rate movements. If interest rates rise or fall sharply, it could affect your income stream and the value of your portfolio. That's why it's important to look beyond just banks and REITs and add companies from other industries to improve your sector diversification. So, how do you do that? One key principle is to look for businesses with a long track record of paying and, more importantly, increasing dividends over time. Why? Because companies that can consistently raise their dividends are usually profitable, disciplined with their cash, and are confident about future earnings. Take Sheng Siong for example. Over the past decade, Sheng Siong has grown its dividends at an average rate of around 8% a year. Grocery demand is steady in both good and bad times, with a low debt, strong free cash flow, and a balanced payout ratio of about 2/3 of earnings. Sheng Siong has the financial discipline to keep rewarding shareholders year after year. Another strong local example is ST Engineering. This is a classic stock that offers both yield and growth. Over the past 10 years, its dividends have grown by about 7 to 8% annually, supported by a diversified business across aerospace, defense, and smart cities. But here's the bigger picture. Don't limit yourself to just Singapore. While Singapore is a great place to start, our market is small and heavily concentrated in only a few sectors. By investing only locally, you miss out on global leaders in industries like technology, healthcare, and consumer brands. For example, Johnson & Johnson has raised dividends for more than 60 consecutive years. Coca-Cola has paid and increased dividends for over 50 years, while Procter & Gamble has an incredible record of more than 65 years of dividend growth. Many of these companies operate on a global scale, generating massive cash flows that allow them to keep rewarding shareholders through all kinds of market conditions. Though, when investing overseas, you also need to be mindful of dividend withholding taxes. US stocks, for instance, impose a standard 30% withholding tax on dividends. The good news is that Singapore investors can often reduce this to 15% by investing indirectly through iron domiciled ETFs, which I will talk about later. Now, of course, not every company that pays a dividend is a good dividend stock. So, let's talk about some of the most common pitfalls that you need to avoid. The first mistake is chasing high yields. On paper, a dividend stock that pays 7 or 8% looks very attractive, but often they are value traps. The reason yields are so high is because the stock price has been falling, or the company is paying out more than it can sustainably afford. Take StarHub for example. Years ago, it was one of the highest yielding stocks on the SGX. In StarHub's annual report in 2011, it was talking about how it was giving a 7% dividend yield. But as competition in the telco space intensified, profits shrank, and StarHub was forced to cut its dividends. The share price also dropped, leaving investors with both smaller payouts and capital losses. Another example is Kinder Morgan, one of the largest pipeline and energy infrastructure companies in the US. Back in 2015, it was boasting a dividend yield of over 10%. On paper, it looked like a dream for income investors, steady toll-like cash flows from transporting oil and gas, and big payouts. But beyond the scenes, Kinder Morgan was weighed down by massive debt. When oil prices crashed, its cash flow couldn't keep up with both debt repayments and dividends. The company was forced to slash its dividend by 75%, and the share price plunged, wiping out billions in market value. Investors who chased the yield ended up with heavy losses. So how do you avoid falling into these dividend traps? The good news is, it's actually not that hard. First, check the company's earnings per share against its dividend per share. You always want to see that the earnings are comfortably covering the dividend. If a company is paying out more than it earns, that's a big red flag. A sustainable payout ratio is usually below 70% because it leaves room for reinvestment and growth. Anything consistently above 100% means the dividends are being funded by debts or cash reserves, which are not sustainable. Second, look at whether the company is able to consistently increase its earnings over time. Dividends are paid out in profits. So if profits aren't growing, it's only a matter of time before the dividend flatlines, or worse, gets cut. A good dividend stock is one where both earnings and dividends are trending upward together. By applying these two simple checks, EPS and dividend coverage, and consistent earnings growth, you can already avoid most of the high-yield value traps out there. However, sometimes even if a company looks like a good dividend stock, the underlying industry itself makes it a poor long-term investment. Dividends come from profits, and if the business is in a structurally weak or unpredictable industry, those profits and dividends will eventually dry up. And that brings us to the second pitfall: investing in bad industries. Some industries are simply not designed to be long-term dividend machines. They may be capital intensive, cyclical, overly competitive, or vulnerable to factors beyond their control. A good example is the telecommunications industry. On the surface, telcos look like steady dividend payers. People need mobile plans and the internet rights, but beyond the scenes, telcos are weighed down by huge capital costs for network upgrades, expensive spectrum licenses, and intense competition that keeps prices low. Over time, this has squeezed profits and forced companies like StarHub to cut dividends, turning what once looked like a safe dividend stock into a disappointment. Then there's the airline industry. Airlines may pay dividends during boom times, but this is one of the most cyclical and unpredictable businesses out there. Fuel costs, recessions, geopolitical tensions, and pandemics can wipe out years of profits outright. We saw this during the COVID-19 crisis, when airlines around the world, including Singapore Airlines, had to suspend dividends completely just to survive. That's hardly the kind of reliability dividend investors are looking for. Last but not least, the oil and gas sector. Energy companies like ExxonMobil or even local offshore and marine players like Seatrium may boast high dividends when oil prices are strong. But oil is a commodity-driven business. When prices crash, earnings collapse, and your share price takes a beating, in 2020, while oil still paid dividends, their stock prices plunged by more than 40%, wiping out far more in capital value than what investors received in income. The best dividend stocks usually come from businesses with a stable demand, predictable cash flows, and simple economics. In Singapore, that include consumer staples like Sheng Siong, which benefits from steady grocery demand, and utilities like Netlink and BN Trust, which runs Singapore's nationwide fibre network and collects recurring income from essential infrastructure. Even ST Engineering fits the bill, with its diversified aerospace and defense contracts, providing reliable earnings visibility. These may not be the flashiest sectors, but their consistency is what allows them to pay and grow dividends steadily over decades. Exactly what you want for a dependable dividend portfolio. Now, here's the thing: doing all the research on individual companies, checking payout ratios, and evaluating industries, it takes time. If you don't have the time, or honestly just don't want the hassle, there's a much simpler way, which is to invest into dividend ETFs. Instead of picking individual stocks yourself, a dividend ETF bundles together dozens or even hundreds of dividend-paying companies into one fund. This gives you instant diversification, reduces the risk of picking a few wrong stocks, and makes it easier to start building your dividend snowball. Basically, you won't buy the wrong stocks if you buy all the stocks. In Singapore, one simple choice is the STI ETF, which tracks the Straits Times Index. It holds 30 of the largest companies here, including banks, REITs, and other blue chip stocks, and currently yields around 3 to 4%. It may not give you the highest yield, but it is broad-based, low cost, and gives you a convenient way to gain exposure to Singapore's dividend payers. Another option is the Lion Philippe S-REIT ETF, which focuses entirely on Singapore REITs. This ETF typically used in the 5 to 6% range, but just know that if you only invest in it, you'll be over-concentrated in real estate, which means your income will be sensitive to interest rate cycles. But you don't have to limit yourself to Singapore. Globally, there are several popular dividend ETFs that focus on companies with strong track records of dividend growth. For example, SCHD, which focuses on high-quality US dividend payers with strong fundamentals. VYM, which holds US companies with above-average dividend yields. Or NOBL, an ETF that tracks the dividend aristocrats, companies that have raised dividends for at least 25 consecutive years. The advantage of these ETFs is that they give you exposure to strong global dividend companies like Johnson & Johnson, Procter & Gamble, and Coca-Cola, companies that have rewarded shareholders for decades. However, as mentioned earlier, one important point for Singapore investors is that the US domiciled ETFs are subjected to a 30% withholding tax on dividends. That means a big bite is taken out even before you receive payouts. To minimize this, some investors prefer to invest into RN domiciled ETFs, which benefit from a tax treaty that lowers the withholding tax to 15%. Example includes FUSD, which invests in a diversified portfolio of high-quality, dividend-paying US companies, and VHYD, which focuses on large-cap companies across global markets with above-average dividend yields. Now, so far, I've talked about how great dividend stocks are and why they can be a powerful tool. But while dividends are important, it is equally important not to get overly fixated on them alone. Here's why. Over the long run, the broader market has far outpaced pure dividend growth. From 1957 until today, the S&P 500 delivered close to 14,000% in total returns, while dividend per share growth was only about 4,000%. In other words, if you only focus on dividends, you have captured less than one-third of the market's gains. Some of the world's most successful companies are not known for being big dividend payers, yet they have created massive wealth. Microsoft, for example, isn't usually seen as a dividend stock, yet it has steadily grown its dividend since 2003. The real story has been its explosive business growth. If you ignore it just because of its low yield, you would have missed one of the greatest stock runs in history. The same goes for Visa. Its dividend yield looks tiny at just 0.7%, but because earnings have grown so rapidly, its dividend has compounded at more than 15% a year. Early investors are now enjoying not just tremendous capital gains, but also high yields on costs. Or take S&P Global, the company behind the S&P 500 index itself. Its yield is less than 1%, but over the past decade, it has raised its dividend at a double-digit pace, while its share price has surged. The combination of dividend growth plus capital appreciation has rewarded shareholders greatly. At the end of the day, whether you lean towards dividends, growth, or a mix of both, the key is to focus on quality businesses that keeps getting stronger year after year. Dividends are powerful, but they are not the only path to wealth. If the business grows, your wealth and your income will naturally grow with it. So don't just chase what looks good on the surface. Be patient, think long term, and let compounding do the heavy lifting. That's how you turn investing into freedom and freedom into a legacy. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every single week.